Most people will tell you to park your first $1,000 in a savings account. In 2026, that's financial suicide. Inflation eats 3–4% a year. Your bank pays you 0.5% if you're lucky. You are losing purchasing power, quietly, every single day. Show graphic, $1,000 shrinking over 5 years due to inflation. If you don't deploy that first $1,000 correctly, you don't just lose money, you lose momentum. And momentum is everything in wealth building. The real question isn't where to put $1,000, it's how to turn it into a system that compounds. Because in 2026, investing is no longer optional, it's survival. The stakes. There's an old world of investing. Slow mutual funds, bank advisors charging 1% to 2%, generic diversification advice. Set it and forget it. That world is dying. Welcome to the new world. AI-driven industries, tokenized ETFs, low-cost index exposure, instant global access. Cut to news headline about AI fund inflows in 2026. Show chart, AI sector growth versus S&P 500 over the last 5 years. Capital moves faster now. Opportunities emerge faster, and risks compound faster. There is a specific structure smart investors use with their first $1,000. Banks don't advertise it. Why? Because it makes you independent. And independent investors don't need high-fee products. But wait, because the biggest mistake happens in Pillar 3, and that's where 90% of beginners lose everything. Let's build this correctly. Pillar 1, the financial shield, $200. First rule of investing, don't invest money that can destroy you. Out of your $1,000, take $200. This is your micro emergency fund. Not $10,000, not 6 months of expenses, just $200 in a high-yield money market or high-yield savings vehicle. Show comparison, traditional savings, 0.5%, versus high-yield, 4 to 5%. This money is not for investing. It is for protection. Car repair, unexpected bill, small emergency. Without this shield, one minor crisis forces you to liquidate your investments at the worst possible time. That's how beginners lose. They panic sell. The shield gives you psychological stability, and investing is 80% psychology. But don't relax yet, because the real growth starts now, and this is where most people either build wealth or stay average. Pillar 2, the growth engine, $500. Now we deploy $500. This is not gambling money. This is strategic capital. In 2026, the most asymmetric growth sectors are artificial intelligence, semiconductor infrastructure, sustainable energy systems. Show graphic, AI, chips, clean energy icons. Overlay performance comparison versus traditional sectors. You do not pick individual stocks. That's ego investing. You use low-cost index ETFs focused on broad AI exposure, semiconductor index funds, clean energy sector ETFs. This gives you diversified exposure inside high-growth themes. One ETF, low expense ratio, instant diversification. Example structure, $300 into a broad AI/technology index ETF, $200 into a sustainable energy ETF. Simple. No day trading, no options, no hype. But wait, here's the trap. Most beginners overconcentrate. They put 100% into one hot stock, and when volatility hits, they panic. Volatility is not risk. Lack of structure is risk. This $500 is your engine. Leave it alone. Reinvest dividends. Add to it monthly. Now we reach the most underestimated pillar, and the one that creates the fastest return. Pillar 3, investing in yourself, $300. Here is the uncomfortable truth. Your first $1,000 will not make you rich, but the skill you buy with $300 might. In 2026, AI automates low-value tasks. It does not replace high-leverage humans. High-value skills today, sales and persuasion, content distribution, AI tool mastery, data literacy, financial analysis, coding automation workflows. Cut to visual, AI tools dashboard interface. Overlay text, leverage greater than labor. $300 invested into a structured course, certification, or technical training can increase your income by thousands, and income expansion is the ultimate investment multiplier. Let's be clear. If you earn $3,000 a month, investing alone won't change your life. If you increase that to $6,000 a month, everything changes. The mistake? Buying random courses, consuming content without execution. That's where 90% fail. They buy information, they don't build capability. Your $300 must create income leverage within 6 to 12 months. If it doesn't increase earning power, it's not an investment. It's entertainment, and entertainment doesn't compound.
Call to action and loop. Now let's resolve the opening statement. Why is a savings account financial suicide in 2026? Because safety without growth is slow decline. The correct structure is this: $200 protection, $500 compounding exposure to high-growth sectors, $300 income acceleration, shield, engine, leverage. That's how $1,000 becomes momentum, and momentum becomes capital. But here's the next level. What happens after that first $1,000? Do you scale the engine? Do you build cash flow first? Do you optimize tax strategy? That depends on one variable most investors ignore: your income velocity. If you want clarity on your next move after the first $1,000, watch the next video on CapitalClarity: how to build a $10,000 investment base without earning more. Because the first $1,000 builds structure, the next $9,000 builds freedom, and in 2026, clarity is your greatest asset.